Hi, welcome to T-Minus Retirement, the podcast where we help launch your retirement into orbit. I'm Jay Cole.
And I'm Dustin Watts.
And in today's video, we wanted to cover, there was an article that recently came out in the Wall Street Journal, and funny enough, it was titled, "Why Are Stocks Up? Nobody Knows." And that's kind of the big thing, because if you go back a couple months ago, so right now it's the end of July of 25, but a couple months ago, the whole outlook of how the market was going to be, especially for the rest of the year, was definitely sour. You had people saying there's huge chances of a recession, of people not spending, of things just going through the roof, and that was causing such a negative downturn or negative outlook with the market overall. Now, fast forward to today, the market's pretty much all of them are almost at all-time highs, if not they are at all-time highs. So
yeah,
we're here kind of to just go over that article and then just point out some reasons why we shouldn't be solely focused on just a specific news outlet or a news story from any given day, because that certainly can change the next day.
I know we've talked about it before, Jay, in some other videos, but one of the things I found interesting in April was that investor sentiment, so investors' appetite for what their outlook was the most negative
It
ever has really been. I mean, it was more negative than COVID. It was more negative than the great financial crisis. And that might have been a combination of, the market was at all-time highs, tariffs came into play. There's obviously political factors there. And so people were just so overtly negative that, the market went down aggressively. And we get to a point where things are so oversold that the market bounces, and we've pretty much had a V-shaped recovery, since those April lows. And I think that really plays into why this is such a hated rally that we have currently going on. Bears or people who are still negative on the market are saying, well, nothing has changed. We still have tariffs. Like, why is the market up? It's got to come down, and all these sorts of things. And I just think that's a very challenging position that you're putting yourself in if you think that way, because in my opinion, a lot of the reasons why the market has bounced the way that it has, which has been one of the best recoveries from a 20% or 15 to 20% decline that we've really ever seen, is the economy really didn't experience as much negative impact as everybody was saying. It was like everybody was saying, everything's going to hell, basically. And when the numbers have come in, it's just you haven't seen that deterioration in the economy. We still have good employment. We have a lot of factors too coming into the second half of the year that are positive for markets. So that might be one reason that markets are up. We have, of course, the tariffs didn't have quite the impact, and they've obviously moved around a lot, but we have interest rates that are expected, at least on the short end of the curve, to start to come down in the later half of the year. We'll see. I mean, I think we've all been waiting for that for some time. We already have the tax policy, inked. So that's a huge benefit to the market, because market doesn't like the uncertainty of what taxes are going to be.
Right.
So,
yeah.
When you have these people writing articles, or you have the news outlets, every day they look to, why is the market up or down? And when there's not one specific reason or something that they can point to, I think it drives them a little crazy. We have to remember that markets trend up more often than they trend down for all sorts of reasons. Also, too, I think positioning in the market is still out of whack, to some degree, because you had either people sell in April, and they went to treasuries or cash, obviously because of the volatility. Now they're chasing the market higher. We certainly, and I know you are probably in the same position, lots of clients have CDs that they were getting 4.5%, 5%.
Yeah.
Those are all renewing. at lower rates. So those people are being dragged into the market. We have to remember that stocks, there's only so much stocks that are out there to buy. But we have more cash that's being inputted into the market all the time, which that's driving up the market over long periods of time. It's simple supply and demand at the end of the day. So I think that really drives people crazy as to they can't point to something and say, why is the market doing this? Sometimes it's just these supply and demand dynamics as well.
Yeah, it's funny that you say the outlook for the year once the tariffs and everything started was much, I forgot how you phrased it, but you said essentially it was much less than how the outlook was during COVID or during the
Yeah.
great financial crisis. That's crazy here because those were two extreme events. COVID, I mean, that lasted a couple of years. I know the market rebounded over that 2020 year, but that was a serious thing. That shut down the entire world.
Yeah. Yeah. So to be more negative because of a one-time tax on a good, versus obviously the world shutting down or literally banks failing and a lot of people losing their homes and their jobs and things, like in the great financial crisis, that just doesn't compute to me. But I think that's why we saw the market so oversold. We saw the VIX spike huge to levels that we don't normally see. It was only a matter of time for the market to at least give some of that back, because we can't have markets don't stay oversold like that for very long. It's very difficult.
Right. Yeah. And markets don't go up steady the whole time.
No, of
That's what
course
people
not.
need to realize too.
Yeah, no. Why don't we bring up the article and we can highlight one of these points, I think, with a chart.
Yeah. There, let's. All right. Do you see it?
Yep, I see the article up.
So yeah, this is from the Wall Street Journal. Funny enough, let me see if I can get this a little bit bigger here. But so Goldman Sachs, and I'm sure many other economists and groups, they essentially will put out what their year-end target is going to be for a specific index, and here it's the S&P 500. And so you can see at the very beginning of the year, they were projecting that the S&P should be ending the year around 6,500. And back when the year started, it was at 5868. So they make that. Everything seems fine. And then, we have a little bit of a drop here. And that's in March. I think this is probably when the tariffs were first being talked about, if I remember correctly. But in March, they revised that year-end statement to be instead of 6,500 to be at 6,200 because of just tariff news. Then we go out a little bit further. Oh, April. I think that's when a lot of the tariffs were either went into place or were extended. But then because of all that, they dropped their target to 5,700. So ending the year at a negative instead of how it started. And you can see the market dropped. But then here's that V. Kind of see here, that was only the span of just a hair over a month. The market recovered, or the S&P 500 recovered from that huge drop, and then again, come May, they revised it from 5,700 to 6,100, essentially ignoring all the tariff news and whatnot. And then if we go out to beginning of July, they're going back up. They're going even higher than how the year even, or how the first year-end projection was. So it's changing based off of what the news is, the news of the day is for that month.
And obviously Goldman Sachs has extremely bright people, and Dave Costin is a very smart strategist. But I think the thing I wanted to highlight is even people whose job it is to make these calls, which it's not an easy thing to do, but they're also reacting to the day-to-day market movement and economic outlooks and all the rest, and they're having to make adjustments, and sometimes things don't play out how economic theory says it should or what have you, and now you can look back, it's like we've kind of made this full round trip, and he's had to even raise his target higher than when we started the year. So it's a very challenging position to be in. I don't envy that kind of job, but what I do think, we can shed some light on is if you're an individual investor saving for a specific goal and investing for a specific goal, really have your sight on that goal and invest according to how long you have until that goal, and how comfortable you are with the ups and downs, because there always will be those. But don't get so caught up in what this economist said, or what this strategist's price target is, or that CNBC came out with this headline, because you'll just always be chasing your tail around and really lose sight of why you're investing. And we don't want to miss out on good market rallies. Certainly, right. I know nobody wants to experience some of those downtimes too, but honestly, that's part of investing. Unless you're a trader and you're trading those things, that's a different conversation. But when we're investing for retirement or investing for some specific goal, you need to have that goal in mind and invest accordingly, not not to what the news story of the day is.
Right, exactly. And then if you ever do have cash on the sidelines and there is a market downturn, that's the best way to put it in.
Yeah, sometimes you have to kind of plug your nose a little bit. Like if you look back to that time, I'll share something real quick. This is a year-to-date chart of the NASDAQ, S&P, and the Dow. Sometimes you have to just plug your nose and start to buy when things are down, in this kind of range. When you see the market that oversold, when you see the VIX spike huge, when everybody's negative. I mean, literally, I can't remember anybody. This was the 8th of April. Everybody was saying we were going to have a recession, inflation was coming back, all the sorts. And, they had a lot of good reasons as to why that was happening, why they thought that. But as we kind of know now, we have the benefit of hindsight, of course. Not all of that played out to as negative as they originally thought. And, we're a little over halfway through the year. We're having a pretty decent year. The returns aren't double digits yet, and they're not, crazy high yet, but I could see, going into the second half of the year with a lot of the tailwinds that we could have another good year. It'll just be a year that we had a lot of volatility, and those years come too.
Yeah.
Anything else you wanted to add, Jay?
No, I think I would just say I'd probably repeat myself from many other videos, but just don't allow yourself to make brash or impulse decisions when it comes to your investment strategy based off of a certain thing, because we'll take the tariffs as an example. People wanted to get out just because the market was going down. Well, then now they missed out on that uptick, and they don't know, people I talk to, at least, they don't know how to get back in or when to get back in, because they might get in and then the market might be down that next day just for a little bit, and they get panicked and pull it out again. So it's hard not to allow your emotions to dictate how your investment strategy is, especially if that's your whole life savings summed up there. But as long as, how you mentioned, you have a good portfolio, and it's diversified and dependent on what your risk is, that's going to really help save you from making those costly and bad decisions when we do have events like this.
And to kind of just sum it up again, it's you don't always have to wait for that positive news to get back into the market.
Right.
Actually, almost always you'll be far too late, because as you can see, even just this year, I mean, things have changed with the tariffs, but we don't have that like golden nugget of just fantastic news as to why the market should be doing what it's doing. If you're always waiting for the perfect risk-free, no war going on type of market or type of world to invest, you'll never be invested. So,
no. Yeah.
Well, we hope you enjoy this video. If you want to check out the article, again, it's called "Why Are Stocks Up? Nobody Knows." It's on the Wall Street Journal's website. We encourage you to check it out. But we do appreciate you watching the video. If you liked it, please like and subscribe, and we'll see you in the next video. Take care.